The world of investments extends far beyond publicly traded stocks. While the stock market is often the first thing that comes to mind, there is a vast and intriguing realm that remains largely hidden from the public eye. Unlisted shares, representing ownership in privately held companies, offer a vast and potentially lucrative market. These shares are not traded on public exchanges, making them less accessible but often more rewarding for those who know where to look. These shares are not subject to the same level of regulatory scrutiny and transparency as listed shares. This lack of oversight can be a double-edged sword, providing both freedom and risk. This creates both opportunities and challenges, demanding a nuanced approach from investors. The absence of stringent regulations means that investors must rely heavily on their own due diligence and expertise. Investing in unlisted shares presents unique risks and rewards, requiring thorough understanding before venturing into this complex market. The potential for high returns is balanced by the possibility of significant losses, making it crucial to weigh the pros and cons carefully. By understanding the dynamics of this market, investors can make more informed decisions aligned with their risk tolerance and investment goals. Knowledge and preparation are key, as is seeking advice from financial advisors who specialize in this area. With the right approach, the world of unlisted shares can offer exciting opportunities for growth and diversification. Unlisted shares hold significant appeal for certain investors due to their potential for higher returns. This potential stems from the growth trajectory of many private companies, particularly in emerging sectors. Unlisted shares offer diversification benefits, often exhibiting lower correlation with public markets. Access to early-stage, high-growth companies is a significant draw for many investors. However, these potential rewards come with inherent risks, such as lack of liquidity and information asymmetry. A cautious and informed approach is crucial when investing in unlisted shares. Unlisted shares present unique risks that investors must carefully consider. Liquidity, or the lack thereof, is a primary concern, as unlisted shares lack a readily available market. This illiquidity can lead to significant delays or discounts when exiting positions. The lack of transparency and information asymmetry in the unlisted market is another significant risk. Valuation is complex and subjective due to the absence of a continuous trading market. Investors must prioritize thorough due diligence and seek professional advice to navigate these complexities. A defining characteristic of unlisted shares is their limited liquidity. Unlike publicly traded stocks, these shares do not have the benefit of being easily bought or sold on a stock exchange. This lack of liquidity can pose significant challenges for investors. This illiquidity stems from the absence of a centralized marketplace, creating challenges for investors seeking to exit positions. Without a readily available market, finding a buyer or seller can be time-consuming and difficult, often leading to delays and potential losses. The illiquidity of unlisted shares translates into an illiquidity discount, reflecting the reduced price investors are willing to pay. This discount compensates for the additional risk and inconvenience associated with the lack of liquidity. This discount varies based on factors such as the company's size and industry. Smaller companies or those in niche markets may experience a higher illiquidity discount compared to larger, more established firms. Unlisted shares are better suited for those with a longer-term investment horizon. Investors who are willing to hold on to their investments for an extended period may be better positioned to weather the illiquidity and potentially reap higher returns. Understanding the dynamics of illiquidity and its impact on returns is crucial before venturing into the unlisted market. Investors must carefully consider their risk tolerance, investment goals, and the specific characteristics of the unlisted shares they are interested in. By doing so, they can make more informed decisions and potentially mitigate some of the risks associated with illiquid investments. The absence of a continuous trading market poses challenges in determining the fair value of unlisted shares. Valuing unlisted shares involves navigating a more opaque landscape due to the lack of publicly available information. Methods like discounted cash flow, DCF, analysis and comparable company analysis, CCA, are commonly used. However, these methods have limitations and rely on assumptions that can be challenging for private companies. Thorough due diligence and professional advice are essential for accurate valuation. Understanding the limitations of different valuation methods is crucial for making informed investment decisions. Investing in unlisted shares demands heightened awareness of corporate governance risks. Private companies often operate with less oversight and transparency than publicly traded companies. Conducting thorough due diligence is crucial to assess corporate governance practices and mitigate risks. Investors should look for boards with a mix of independent and experienced directors. Transparency and financial reporting are critical areas of focus. Understanding the management team, industry dynamics, and market opportunity is essential for a comprehensive view of potential risks and rewards. Investing in unlisted shares offers various avenues for generating profits. These opportunities can be quite diverse and often require a keen understanding of the market dynamics. One common path is through a liquidity event, such as an initial public offering, IPO, or a sale of the company. These events can significantly increase the value of the shares held by investors. An IPO allows a privately held company to go public, providing an exit opportunity for existing investors. This transition from private to public can lead to substantial financial gains, as the market often values public companies higher. Another potential avenue is through a sale of the company to a strategic buyer or private equity firm. These buyers often seek to acquire companies that align with their strategic goals or investment criteria, offering a lucrative exit for current shareholders. Beyond liquidity events, investors may also benefit from dividend distributions, although these are less common. Dividends provide a steady income stream and can be a sign of a company's profitability and stability. Understanding these avenues is crucial for capitalizing on the potential of the unlisted market. Investors need to stay informed about market trends, company performance, and potential exit strategies to maximize their returns. Networking with industry professionals and attending financial seminars can also provide valuable insights and opportunities in the unlisted market. Building a strong network can lead to discovering promising investment opportunities early on. Regularly reviewing and adjusting investment portfolios based on market data and trends is essential. This proactive approach helps in making informed decisions and optimizing returns in the unlisted market. Private equity and venture capital represent high-risk, high-reward segments within the unlisted market. Private equity firms invest in mature companies with potential for operational improvements. Venture capital focuses on early-stage companies with high growth potential but unproven business models. These investments require significant capital commitment and a long-term investment horizon. The illiquidity and high failure rate of startups underscore the importance of diversification and understanding the risks involved. Thorough assessment of the fund's strategy, track record, and management team's expertise is essential before committing capital. Understanding the key differences between unlisted and listed shares is crucial for informed decisions. Listed shares offer liquidity and transparency, with greater disclosure and investor protection. Unlisted shares lack liquidity and transparency, with more complex valuation and fewer avenues for recourse. Choosing between unlisted and listed shares depends on an investor's risk tolerance, investment goals, and understanding of each market's unique characteristics. Investing in unlisted shares requires a cautious and informed approach. Thorough due diligence is paramount before committing capital to any unlisted company. Diversification is crucial for managing risk in unlisted investments. Building relationships with reputable sponsors can provide access to vetted investment opportunities. Patience and a long-term perspective are essential for success in unlisted investments. Expecting quick returns or panicking during market downturns can lead to poor decision-making and erode potential gains.